If you've renewed your car insurance in the last year or two, you probably have the same reaction most people have. Why is this so much more than it used to be? You didn't cause an accident, you didn't get a ticket, nothing changed on your end, but your premium went up anyway, maybe significantly, and you're not imagining it. The average cost of full coverage car insurance in the US is now over $2,100 a year. That's up over 40% since 2021. Some states are even worse. If you're in Michigan, New Jersey, or New York, you could be paying well over $3,000 a year. And the frustrating part is that most people don't know why it's happening, which means they don't know what they can actually do about it. That's what we're going to walk you through today. Not just that car insurance is expensive, you already know that, but the specific reasons why it got this way, whether it's going to get better, and what options you reasonably have. My name is Jim Eddington, and my agency helps individuals and families navigate these kinds of situations every day. So let me explain what's actually driving this. The biggest single factor is the cost of claims. That's really what it comes down to. Insurance companies collect premiums from everyone, and they use that money to pay claims when accidents happen. When the total cost of those claims goes up, premiums have to go up to keep up pace. And over the last few years, claims costs have gone up dramatically, not just because of one thing, but because several things happening at the same time. Let's start with the cost of fixing cars, because that's probably the biggest piece. Modern vehicles are packed with technology that didn't exist 10 or 15 years ago. A bumper isn't just a bumper anymore. It's got sensors, cameras, radar modules, lane assist, parking assist, automatic braking. A fender bender that used to cost $800 to fix can now cost $3,000 or $4,000 because you're not just replacing sheet metal, you're replacing and recalibrating electronic components. And it's not just the parts. Labor rates at body shops have gone up substantially. There's a shortage of qualified technicians who work on these newer systems, and that drives labor costs higher. On top of that, supply chain issues that started during the pandemic haven't fully resolved. Parts take longer to get, so the car sits in the shop longer, which means the insurance company is paying for a rental car longer. The average cost per claim has increased dramatically, and that gets passed through the premiums. The insurance company isn't absorbing it. They can't, at least not indefinitely. They pass it to you. Now, the second factor is medical costs, and this one is big. When someone gets hurt in a car accident, the medical bills are often the largest part of the claim. And healthcare costs in this country have been climbing steadily for years. Emergency room visits, surgery, physical therapy, diagnostic imaging, all of it costs more than it did 5 years ago. A moderately serious injury from a car accident can easily generate $100,000 or more in medical bills. That's before lost wages or pain and suffering even enter the picture. Insurance companies are paying those medical claims, and the higher those medical costs go, the more premium they need to collect to stay solvent. This isn't unique to auto insurance. It's a healthcare cost problem that shows up in your auto premium because auto insurance covers injury. The third factor is something the industry calls social inflation. And it's worth understanding even though the name sounds abstract. What it really means is that jury awards and legal settlements have been getting larger. When an auto accident goes to litigation, the amounts the juries are awarding to plaintiffs have been trending upward, sometimes dramatically. What used to settle for $200,000 might now settle for $500,000 or more, depending on the jurisdiction. Part of this is driven by litigation funding. That's third-party companies that finance lawsuits in exchange for a share of the settlement. That means more cases go to trial instead of settling early. And the cases that do go to trial tend to result in larger verdicts. For the insurance company, that means higher payouts on liability claims. And again, those costs get built into your premium. There's also the simple reality that people are driving more and driving less safely. After the pandemic, when things were empty and accidents dropped, driving returned to pre-pandemic levels. But the risky behaviors that developed during the low traffic period stuck around. Distracted driving is worse than ever. Speeding is up. Fatal accident rates spiked in 2021 and 2022 and haven't fully come back down. More accidents with more severe outcomes mean more claims, and more claims mean higher premiums. And then there's the weather. This one doesn't get talked about as much in the context of car insurance, but it matters. Severe storms, hail, flooding, these events generate massive numbers of comprehensive claims all at once. A single major hailstorm can damage thousands of vehicles in one metro area in one afternoon. The insurance companies pay those claims, and the cost shows up in premiums across the board, not just for the people who filed the claims. So that's the picture. Repair costs went up, medical costs went up, legal costs went up. Accident frequency and severity are up, weather losses are up. Every component of what makes up a car insurance claim has gotten more expensive, and all of those increases compound on each other. Now, the question everyone asks, is it going to get better? The honest answer is somewhat slowly and unevenly. Nationally, rates actually have come down about 6% in 2025 after 2 years of sharp increases. That's encouraging, but it didn't happen evenly across the board. 39 states saw decreases, but some of the most expensive states like Michigan, New Jersey, and Washington, D.C. actually saw rates go up even further. For 2026, the projections are roughly a 1% increase nationally. That's much more manageable than the 18% jump we saw between 2023 and 2024. If those tariffs push repair costs higher, some analysts project that 1% could become 3 or 4% by the end of the year. So the trajectory is better, but it's not a guarantee of relief, and it depends heavily on where you live. So what can you actually do about it? Let me walk through the things that actually make a difference, not the generic advice you've heard 100 times. First, shop your coverage. This is the single most impactful thing you can do. Insurance companies reprice risk constantly, and the rate you're paying with your current carrier may not be competitive anymore. The same profile, the same car, the same driving record, same zip code can produce dramatically different premiums from different carriers. We see this constantly. Someone comes to us paying $2,400 a year and we find comparable coverage for $1,600 with a different company. That's not a gimmick, it's just how the market works. Carriers have different appetites for different risk profiles at different times. Second, look at your deductibles. If you're carrying a $500 deductible on your collision and comprehensive coverage, increasing that to $1,000 or $1,500 can really meaningfully reduce your premium. The trade-off is that you pay more out of pocket if you have a claim, but if you haven't had a claim in years, you've been paying a higher premium for a lower deductible you're not using. That math is worth looking at. Third, make sure you're getting every discount you're entitled to. There's multi-policy discounts for bundling auto with homeowners or renters insurance. There's safe driver discounts, low mileage discounts if you work from home or don't drive much. There's discounts for paying in full rather than monthly installments. There's even discounts for paperless billing or auto pay. Individually, these are small, but stacked together, they can add up to 15 or 20% off your premium. Fourth, check whether your coverage still matches your situation. If you're driving a 12-year-old car that's worth $4,000, carrying full coverage with a low deductible might not make financial sense. You're paying a premium to insure a vehicle that the insurance company would total out for less than what you're paying over 2 or 3 years of premiums. That doesn't mean drop all of your coverage. Liability is non-negotiable, but right-sizing your physical damage coverage to match the actual value of the vehicle is a legitimate way to reduce your cost. And fifth, and this is the one most people skip, review your policy at every renewal. Don't just auto pay and move on. Look at what changed, look at what you're paying, and ask whether it still makes sense. The insurance market shifts constantly, and what was the best deal 2 years ago might not be the best deal today. The bottom line is this: car insurance is expensive right now for real structural reasons, not because your insurance company is gouging you, but because repair costs, medical costs, legal costs, and claim frequency have all gone up, and premiums reflect that reality. The good news is that the worst of the increases appear to be behind us, and there are real steps you can take to manage what you're paying without sacrificing the coverage you need. And if you're in money saving mode right now, which if you're watching this video, you probably are, and you're also paying too much for health insurance, I made a video about an alternative that saved my own family tens of thousands of dollars. Check that out right here. If you want help figuring out whether you're paying more than you should, or you just want someone to look at your current setup and see if there's a better option, that's exactly what we do. For auto insurance, we work with individuals and families and businesses in Arizona, California, Nevada, and Utah. There's a link in the description. You can get a quote and we'll help you figure out where you stand.